Imagine opening a forex chart and instead of seeing random chaos, you actually see a clear story unfolding before your eyes. You can tell where buyers are stepping in, where sellers are getting weak, and where the next big move could happen. That's the power of reading forex charts like a professional. But here's the problem. Most beginners get lost. They see candlesticks and indicators everywhere, but they don't know how to connect the dots. That confusion leads to poor decisions and blown accounts. In this video, I'll teach you how professionals break down forex charts step by step. By the end, you'll know how to read candlesticks like a language, spot key support and resistance zones, identify trends with confidence, recognize chart patterns that repeat, use indicators the way pros actually use them, and understand the hidden psychology behind market moves. Make sure you watch until the end, because I'll reveal one advanced tip that separates average traders from chart masters. At its core, a forex chart is just a graph of price over time. But don't underestimate it. It's the roadmap of the market. Professionals prefer candlestick charts because they give more detail than simple line charts. Each candlestick shows four things: the opening price, the closing price, the highest point buyers reached, and the lowest point sellers pushed to. If you see a green candle, buyers dominated that time period. If it's red, sellers had control. Imagine you're watching the euro to US dollar on a 1-hour chart. The candle opens at 1.1000, closes at 1.1050, and has a long wick on top. What does that tell you? Buyers pushed the price up, but sellers fought back near the top. That wick is a story of rejection. Time frames matter. A bullish candle on a 5-minute chart might look meaningless on a daily chart. Professionals always check multiple time frames, the higher ones for the big picture, and the lower ones for precision entries. Support and resistance are the backbone of chart reading. Support equals the floor where price bounces up. Resistance equals the ceiling where price struggles to break through. Think about it like this. If price keeps rejecting a level multiple times, it's like a battle zone. Buyers defend support. Sellers defend resistance. Picture pound sterling to US dollar approaching 1.2500. Each time it touches this level, buyers push it back up. Traders start recognizing this as a strong support zone. Now, if the price finally breaks below it, professionals don't panic. They know it often means the floor has turned into a ceiling. The more times price touches a level, the stronger it is. But beware, every touch also weakens it because it shows the level is being tested. To practice, pull up a chart and draw horizontal lines where price has bounced repeatedly. You'll instantly see how important these levels are. If you only take one principle from today's video, let it be this: the trend is your friend until it ends. A trend isn't random. It's the market's direction. An uptrend equals higher highs and higher lows. A downtrend equals lower highs and lower lows. Sideways equals consolidation. If euro to US dollar has been climbing from 1.1000 to 1.1200, making higher highs and higher lows, that's an uptrend. Smart traders don't fight it, they look for buying opportunities. Use a trend line. In an uptrend, connect 2 or more swing lows. In a downtrend, connect the highs. Suddenly, the trend isn't abstract anymore, it's visible. Pause right now, look at your trading platform, and ask, is the market trending up, down, or sideways? That one question alone can prevent a lot of bad trades. Professional traders love chart patterns because they reveal human behavior. Head and shoulders, a classic reversal signal. After an uptrend, it shows buyers running out of steam. Double tops slash bottoms show powerful rejection at a level. Triangles indicate compression before a breakout. Imagine the market forms a double top at 1.3000. Price pushes up twice but fails both times. Professionals see this not as coincidence but as a strong sign of seller dominance. When the neckline breaks, they prepare for a downward move. Don't treat patterns as guarantees, they're probabilities. Always wait for confirmation. That's what separates pros from gamblers. Here's where many beginners go wrong. They overload their charts with 10 different indicators. Professionals keep it simple. Moving averages smooth out the trend. A 50-period moving average is a favorite for swing traders. RSI, Relative Strength Index, tells you if the market is overbought or oversold. MACD confirms momentum and crossover signals. Suppose price is trending up and the RSI is showing strength without being overbought. That's confirmation to stay in the trade. But if RSI hits extreme levels while price touches resistance, that's a warning signal. Indicators don't predict, they confirm. The chart comes first. Indicators are assistants, not masters. Now for the advanced tip I promised. Candlestick psychology. Each candle is more than numbers. It's emotion. A long wick shows rejection. A doji, small body, shows indecision. A strong bullish engulfing candle shows buyer takeover. Imagine a strong downtrend. Suddenly, a giant bullish engulfing candle forms at support. Professionals don't ignore that. They know it could mean sellers are exhausted and buyers are taking control. This is the professional edge. Reading candles as a story rather than just shapes gives you insight into what traders are thinking in real time. Let's put it into a simple routine you can use every day. Start with a higher time frame, daily/weekly, to see the big picture. Mark key support and resistance zones. Identify the overall trend. Drop to a lower time frame for entry precision. Watch for candlestick signals and confirmation from 1 or 2 indicators. That's it. Simple, repeatable, effective. So now you know how professionals read forex charts. It's not about predicting the future. It's about understanding the story the market is telling you. If you found value in this, smash that like button and subscribe for more trading insights. And I want to hear from you. What's the one thing about chart reading that confuses you the most? Drop it in the comments. I'll pick one and make a full video breaking it down for you.